Hi there, it's Dan Kurz, DK Analytics. It is October 31st, 2019. Happy Halloween, everybody. The video topic for today is doubling down on fiat insanity while investors remain in denial. Some valuation metrics: the trade-weighted US dollar stood at 92.01 as of the latest available statistic. Intraday prices coming up here. The US 10-year stood at 1.69 yield, 1.69% yield, the 10-year Treasury. The S&P 500 at 3,034. Oil at $53.78. Gold at 1,512 US dollars per troy ounce, and silver at 1805 US dollars per troy ounce. The dollar looks to be topping out. The 10-year yield on the US Treasury is up 15% since its September low of 1.47%. The S&P 500 has climbed to an all-time high on the back of accommodative Fed actions, including yesterday's Fed announcement of a 25 basis point cut in the Fed funds rate with a stout inflation tolerance bias on board. More on that later. Oil is stuck in the mid $50 range, and the dollar price of precious metals has failed to retrace a substantial portion of a recent correction, or let me say the majority of a recent correction, despite accelerating monetary debasement or debasement announcements pretty much around the globe. In fact, despite a broad daylight, out of the closet, Banana Republic style monetization of US government debt now being returned to, namely 60 billion per month. Despite this, the dollar-based precious metals prices, or should I say investors in precious metals, remain unimpressed. And this is despite the fact that the Fed could only shrink its balance sheet by about 850 billion since it started to around 3.2 trillion recently. That is after bloating it from around 830 billion pre-financial crisis in December of 2007, all the way up to over 4.1 trillion by 2014. So much for going back to a $830 billion balance sheet, much less twice that, or 1.6 or 1.7 trillion. So much for debt monetization not. This should be ringing bells with investors. Let me preface further remarks by stating what I mean by fiat. First, one definition of that term: an arbitrary order. An arbitrary order is the antithesis of what the US and, to a material degree, OECD/Western nations are supposed to be all about, namely representative government, the rule of law/constitutionalism, inalienable rights that neither a tyrant nor a mob can alter arbitrarily, and of course, sound, scarce, precious metals-backed currency, which disables deficitary redistributionism as well as undue concentration of power. It's the anti-tyranny medicine. It's what undergirds freedom, a stout economy, and widespread wealth, as history shows. In the US today, and by extension much of the West, we have an increasingly arbitrary, capricious, rapacious, unrepresentative, despotic ruling elite, also known as the bureaucracy, the unelected bureaucracy, and their elected hangers-on, which effectively makes policy and determines what money is and how much of it to issue for the benefit of those that help sustain and grow the bureaucrats and their elected hangers-on increasingly entrenched power, as well as their post-office lobbyist wealth. This is true if it is the ruling elites cozying up to their corporate pals to craft favorable legislation, oligopolistic access, or massive bailouts that then get showered on their K Street or on their Wall Street pals. It is equally true when redistributionism is showered on the massive taker and third world amnesty communities who will gladly vote for cotton candy on offer in a roughly 15-to-1 ratio to the Main Street entrepreneurs that are getting fleeced. Both beneficiaries, corporate welfare recipients, and takers have been showered with redistributionism, also known as Main Street maker theft, enforced by those that control the instrumentalities of government, by those that command both the police and the armed forces to force compliance, regardless of lacking merit, constitutionality, and Bill of Rights fidelity. In the US, with a statist-loving press, underpinning, even leading democratic efforts to remove a president duly elected by Main Street deplorables on ever more grotesque and criminal display. With this taking place, I'd argue that we are skating on thinner and thinner political stability ice. This is something which I have highlighted often in publications, including Post 52, titled, "Given that the left still refuses to accept the 2016 election outcome, we are in a very dangerous place," and in Post 37 about rising political risks, and in Post 35 titled, "Can the truth exhuming alt media trigger a rule of law revival?" If the current Banana Republic impeachment circus cannot be reeled in, well, prior to the rapidly approaching November 2021 election, we could face a confidence-drubbing double whammy, namely huge political and financial uncertainty, the ugly offspring of fiat government and fiat money for the vast majority of the population. My point, bubble land valuations, including bonds, stocks, and real estate, may be facing more than one big, fat, ugly needle. How much longer will bubble valuation bonds and stocks and investors in the same remain in denial? Before I shift to Q3 US earnings results, and before I hone in on capital markets denial, let me mention a few things that caught my attention last night as I listened to the Fed show where Chairman Powell spoke and then answered softball questions. Those questions. Mine. Why lower the effective funds rate by 25 basis points to between 1.75% and a 2% effective federal funds rate if the economy is sound and the consumer strong? My second question would have been, why the Fed willingness to accommodate a substantial and sustained rise in inflation prior to the Fed even considering raising interest rates, especially as the inflation rate has already pierced the erstwhile 2% ceiling? Obviously, these are more rhetorical than actual questions. In other words, I think the answer is pretty self-evident. But I think there are significant questions that investors are not asking in broad enough terms. The sobering answers to those questions. Question number one, the economy is really weak and getting weaker. That's why you can't, that's why there's further interest rate reduction and not an ability to raise rates that a stronger economy would allow. Some people are enthused or were enthused by the Q3 real GDP growth rate coming in slightly above reduced expectations at 1.9%, which is weak. So weak that Trump used to lambaste it, all right? But even if one takes that pedestrian at best GDP growth rate, it was powered by consumption, which in turn was financed by more spending out of an empty American pocket, and an unexpected, unprecedentedly leveraged consumer. Corporate sector debt at levels never seen before, and public sector debt at levels never seen before. In other words, growth through taking on even more debt at the consumer, corporate, and public sector level. Question number two, the Fed willingness to accommodate inflation. What Powell is really saying on the inflation front is let it rip, because given the severely leveraged and interest rate sensitive economy that we have, we can't afford higher interest rates even as the Fed fans the monetary base fire, which may initially blow even more air into asset bubbles, but is beginning to spill over with increasing impact on consumer purchases, from health insurance to housing to tuition to food and beyond, and that's with a strong dollar. Therefore, let me restate my title in my earlier remark. How long will bond and stock markets, that is, investors in bonds and stocks, remain in denial? We all know that the net present value, the market value of bonds and stocks, which are tied at the discounting rate HIP, are very interest rate sensitive. It isn't just earnings in stocks, it's also the rate at which you discount future expected earnings back. Both matter, and incredibly much. I have two detailed posts on just this for you to glance at, should you be interested in taking a closer look, namely post number 47 and post number 25. Let me now shift to the U.S. corporate third quarter results that are piling in. S&P 500 gap EPS, that is with continuing restructuring charges on board, meaning unless they left the business, they're all in there, and these weigh down on earnings but are a vital depiction, a fair depiction of reality, whereas operating earnings aren't. So the S&P 500 GAAP EPS as per Q3 results insofar are as follows. S&P 500 EPS of $105.07 per share over the first 9 months of the year are up 1.6%, 1.6% year to date. And the results for Q3 19 on a year-over-year basis are down 3.4%, specifically to EPS of 35.12 per S&P 500 index from 36.36 back in Q3 18. So we've got a 3.4% reduction in EPS in the last quarter, very slow and slowing EPS growth for the year so far. And don't forget, sustained stout stock buybacks have flattered EPS growth beyond net profit growth. This is unsustainable, and it will reverse, especially if stocks come under lots of pressure. I'm going to say when stocks come under a lot of pressure, and leveraged balance sheet companies need to, you guessed it, sell equity via secondary offerings after stock prices have cratered. This happened in 2009 and previously as well. How history repeats. Moreover, U.S. corporate pre-tax profits have already been under pressure for quite a few years, as I have detailed more than once in publications of various sorts, reflecting margin pressure off of record margins a few years back. That margin pressure is something that has been powerfully offset of late at the after-tax level by Trump's stout corporate tax reduction and by the sustained and prodigious stock buybacks that ZIRP, zero interest rate policy, has enabled, which has further conspired to boost after-tax earnings at the EPS level, leveraging them at the EPS level. For a graphic depiction of pre-tax profit / margin pressure, please see the chart I'm going to hold into place here, where pre-tax S&P 500 profit falls from 2330 in late 2014 to 2,085 billion in Q2 19. That is, from 2,330 billion in pre-tax profits in late 14 to 2,085 during the latest quarter, 2,085 billion in pre-tax profits in the latest quarter, which is a 6.5% decline. Let me see if I can get this on the camera here. There we go. All right. This is corporate profits, and it actually extends beyond the S&P 500, so it's a more complete picture of corporate America. And I'm referring to this high point here in late 2014 down to where we are currently, and that is a 6.5% reduction. And it could be a trend. I think it is, for all the reasons I've already mentioned. Now, one can argue that only so much financial engineering based EPS enhancement is possible. I think that makes sense, and I think you'd subscribe to that too. This is especially when fundamentals, again, matter more. A recession that could prove to be long and deep arrives or manifests to a greater degree, and when a valuation reset, lower PEs, higher bond yields, begins. That valuation reset may prove to be lengthy in duration. For lengthy flavor, consider the following. The S&P 500 index reached 108.37 in November of 1968. It didn't consistently exceed this high water index mark until May of 1982. That's 13 and a half years. That's quite a revaluation stretch defined by falling EPS themselves, by falling PEs, themselves reflecting higher inflation and higher interest rates, something which is highly likely to be in our future again, but on steroids given our historic money printing trajectory. Thus, under the S&P 500 hood, things are actually a lot less celebratory than at the GAAP EPS level, which is nothing to write home about either, as I have posted twice in the past 2 years or so. Meanwhile, the S&P has surged by over 19% year to date to over 3,000 to a new record, and sports a trailing 12-month GAAP EPS PE of 22.7, nearly 23 times. Not exactly cheap, especially not if earnings per share are poised to fall off a cliff, which, as you know, remains my contention, my conviction. Does anyone see a valuation disconnect continued here? As EPS start to lose altitude prior to coming under pressure precipitated by steep recessionary P&L P&L pressure, do you think this is going to be lost on investors? I don't think so. And by the way, I would be remiss if I didn't mention that I have thought this for the past 2 years. Yet, as I keep saying, the monetary heroin stock market has become a lagging indicator. It used to be a leading indicator. It used to sniff out a recession and EPS compression before, not after the event. Alas, not today, as the U.S. stock market just set all-time records this week on more easy money from the Fed and recycled trade deal hopes amidst deteriorating fundamentals. As regards deteriorating fundamentals, consider October headlines such as the U.S. services gauge dropping to a 3-year low as hiring slows. By the way, hiring is always a lagging indicator. U.S. payroll growth comes in below estimates as wage growth slows. Heavy truck orders continue to collapse. GE freezing pension benefits to cut the funding deficit, a preview, in my opinion, of wide corporate and public sector attractions. October also showed yet another loss in manufacturing jobs in the U.S., while new jobs, whatever their quality, came in at a sedate 125,000, even as the prior month's weak new job creation number was revised to the downside by 30,000. Finally, October continued a slump in business spending. Now, some equity investors, as I mentioned, will take solace in the consumer spending powered 1.9% real GDP growth print released yesterday by the government's statisticians, even as they ignore the growing consumer debt, which has sustained consumer spending, from auto loans starting to go sour to unpayable student loans for leftist indoctrination. To highlight why consumers have to go more deeply into debt to continue to spend, consider just one data point. Long-raging healthcare insurance inflation, which has pushed average family healthcare insurance spending to the 20,000 annual mark in the United States, which that 20,000 easily eats up a whopping third of an average family's income all by itself. By the way, for stark contrast, if not totally fair or representative or comparable, when I first acquired healthcare insurance in the early 80s, it cost me $25 per month. Let's cut to the chase. The stock market is addicted to the Fed's monetary cocaine. Fundamentals be damned until they can no longer be damned. That is, when EPS starts to implode, or when fiat currency and the bonds priced in it are no longer trusted and interest rates do a moonshot. So it's either sooner or later. In the interim, thank the Fed, once again, for the dichotomy between a bullish stock market and increasingly cloudy EPS prospects. Thank the Fed for quickly abandoning its mini tough love trajectory after last December near stock market meltdown in the US on both the interest rate and on the balance sheet normalization fronts. That is, the Fed abandoned both. Thank the Fed for its December 2018 induced policy 180, in other words, and its rapid revision back towards ZIRP, which lasted for 8 years, as well as return to huge balance sheet expansion as balance sheet shrinkage, or QT, proved to be unsustainable and repo rate unsettling. I've said multiple times that QT would prove unsustainable, including in post 42, for anyone wanting to take a closer look. Why? It's thanks to our toxic public policy stew, which rewards takers, illegals, debtors, bureaucrats, and cronies over Main Street makers, citizens, and savers/creditors. I know, I have repeated this many times, but it remains the neglected truth for both creditors/bondholders and shareholders. Caveat emptor, buyers of bubble valuation bonds and stocks. In the interim, in the most inflated part of the stock market, namely in IPOs, we see weakness. Those IPOs are starting to crack. Those crazy IPO valuations of recent greater fool speculations such as WeWork, Lyft, Uber, Chewy, CrowdStrike, etc., they are coming undone. Recent prices are far, as in typically 50% plus, below the IPO prices and even further below the initial scripted post-IPO stock price boosts. Which begs the question, how much longer will investors underwrite severely cash-burning / loss-making operations. From Netflix, in terms of cash burning, all these names apply. From Netflix to Tesla to Uber to shale oil companies to cryptocurrencies, which don't even have profit and loss statements. And what happens when sentiment shifts from return on capital to return of capital and to purchasing power maintenance, as I keep asking? Moreover, what happens when confidence in the greater fool theory morphs into fear that, quote, I might be the fool left holding the bag, unquote, with no one else to sell my shares to unless I accept much, much lower prices? The IPO market obviously has huge implications for overall equity market valuations. It's sort of a weather vane. And this is especially true if one dials in the reversion beyond the mean tendencies of manic depressive markets. Meanwhile, the junk bond market, still a bubble, and now newly and recently stoked and aggressively stoked by a Fed quickly lowering interest rates and embarking on roughly $60 billion of monthly Treasury bill purchases to push down short-term rates, while also providing $130 billion of liquidity to an increasingly liquidity-starved repo market. That junk bond market should prove to be a canary in the coal mine, much as it did in 2008, albeit in unparalleled 2019 bubble caveat terms. The Fed's preemptive attempts to keep bond and stock market bubbles from popping this time around, preemptive, have already dashed this otherwise highly sensitive market from signaling broader economic and financial trouble. Point in fact, the average U.S. junk-based bond yield 2 days ago hit a 2-year low of 5.43% after a 13-session rally, which provided a year-to-date return 2 days ago of 12% in junk bond land, mind you. In terms of junk bond yield spreads to the 10-year Treasury yields, they remain low, mirroring low junk bond yields, obviously. This should change quickly as junk bond creditors start to sniff recession and insolvency in advance of the stock market. How so? Via sharply rising yields, via sales of these junk bonds. Call it an extension of the repo market yield explosion banks have faced to non-investment grade firms across a wide spectrum. So while banks have had trouble with a repo market yield explosion, non-investment grade firms would have bellyaches if the wider junk bond market fell out of bed. And when it does fall out of bed and junk bond yields surge, they will be very hard to contain because it'll spread like a wildfire. In fact, like I said, it will feed on itself and in typical manic depressive and reversion beyond the mean fashion. This is especially apt, this kind of bond price collapse in the junk bond arena, given our geriatric, feeble, financial repression-based expansion, during which non-financial U.S. corporate debt has grown by $3.1 trillion since Q4 07 to $6.5 trillion currently, during which there are only 2 U.S. corporate debts or names left that carry AAA ratings, Microsoft and Johnson & Johnson. And C, a time during which there's been a long, sustained glut of subprime debt issuance accompanying the LBOing / leveraging of an anorexic corporate America. A corporate America focused on C-suite enrichment over organic growth and product portfolio competitiveness to an unprecedented degree, something which, as I've mentioned, is evidenced by our larger than ever trade deficits. We don't have product portfolio competitiveness. Obviously, that's a different story for Japan, for high currency, high wage Japan, Germany, and Switzerland, which have long managed either trade surpluses or balanced trade with China. If non-investment grade companies lose access to short-term funding via the banks and to long-term funding via the junk bond sector of the capital markets, then look out below. And the Fed knows this, which is why it's doing what it's doing. As banks increasingly distrust each other's loan and derivative exposure books, this is a huge concern, which is why private sector repo rates recently shot into double digits, and why the Fed has parked $130 billion of printed money into calming this market down and bringing rates into line, bringing them to heel with the Fed funds rate diktat. And the Fed will continue to up the ante here. No, until October 25th, repo support BS, or simply more such BS. That is, it will not be executed. It will simply be violated, or the Fed will extend repo assistance. Why will it do this? In an effort to offset the private sector's perception, which is proving very hard to dislodge, of rising illiquidity and insolvency risks, risks that the very policies of the Fed have spawned in the first place. If non-investment grade companies lose that funding access, then this will begin, in my opinion, 2008 revisited. Except that this time around, we have much more money printing enabled debt, much more financial repression spawned bubble misallocations, and the ensuing much worse productivity. And this is exactly what the repo market is sniffing out. A market where private sector institutions / banks can get overnight financing with which to A, stay liquid, B, bridge asset liability duration mismatches, inevitable part of doing business as a bank, and C, to initiate and to sustain short-term financing and refinancing, such as commercial paper to fund corporate working capital needs. This, in aggregate, is why the repo market is a canary in the liquidity coal mine. But, as mentioned in my prior video, it's really just smoke from a savings-starved, highly indebted world fire, itself once again the progeny of yield starvation and global counterfeit currencies electronically printed into existence in an absolutely unprecedented manner. And as you contemplate what a global central bank bubble market rescue will look like, consider, if you would, that the global central bank balance sheet, all the major central banks, is already some 16 trillion higher than it was 11.5 years ago. That global debt, furthermore, that global debt recently reached 247 trillion, or 3 times global output, or GDP, a level which is a whopping 105 trillion higher than it was at year-end 2007. Meanwhile, and to restate, interest rates around the world are on the floor. My point, with such leverage and misallocations and with virtually no interest rate playroom other than going deeply into negative rates, arguably the ultimate form of Frankenstein finance and highly destructive to economic growth, consider how drastic central bank money printing is going to have to be to counter/neutralize private investors running for the hills, not first and foremost to achieve a positive return on capital, but once again to see a return of their capital, their purchasing power. This is when investors will really wake up and force central banks' hands like never before. With that said, let's take a brief look at the currently narrow 3.87 percentage point spread between junk bonds and the 10-year Treasury chart, which is not much higher than the current cycle yield spread low of 3.28% in September of 2018. See if I can get this into place. There we go. Now, we're talking about right here, this spread not being much higher than in earlier this year in the spring. All right, and I'm sorry, in 2018. And we're also talking about the fact that, as this chart should hopefully show clearly, let me get this back up here, that within 7 months, all right, within 7 months, there we go, from May 07 to December 07, the spread, have I got it? Yes, I got it. The spread shot up by 141%. This is right here, from here to here, right? Shot up by 141%. We're talking about the junk bond spread to treasuries. And it ultimately reached a high of 1988 up here, a yield, the spread of 1988 in November of 2008 at the peak of the financial market meltdown. Today's spread can widen abruptly and, together with other liquidity and solvency issues, metastasize/spread very quickly, turning confidence/trust in the fiat currency status quo into illiquidity and insolvency concerns nearly overnight. We saw this in 2008, and we should see it again now, especially as debt to GDP is much, much more elevated around the world, and because yields on bonds of all sorts, from government bonds to investor-grade corporates to negative yielding junk bonds in Europe, are incomparably puny. A domino effect starting to kick in, which will drag the lagging equity market indicator with it when that first domino chip falls. That is, the repo problem goes to the junk bond market, and rates reflect it. Note that between May 2007 and December 2007. The S&P, by contrast, okay, to the junk bond spread, which surged by 141% from 2.46% to 5.92%, the S&P during the same period from May 07 to December 07, it only fell by 4.1%, namely from 1531 to 1468. And let me see if I can bring that on board here. Here we go. Okay, we're talking about from here to here. Crashing junk bond and stock markets will ultimately also engulf investment-grade government bonds once money printing at the world's leading central bank kicks into high gear. I keep referring back to, our fiat issues today, the title. And I think central banks will have to, given the debt and their bloated balance sheets and the reduced efficacy of additional attempts at stimulation, will have to print unprecedented amounts of money. However that's distributed can even be to individuals or corporations, in addition to parking the excess balances on central bank balance sheets. This, when it happens, will make the destruction of fiat money, and thus its purchasing power, just too painfully obvious for investors to continue to ignore or sweep under the rug, and it will end their denial. This is most especially true for the most indebted, most foreign financing dependent currency in the world, the US dollar. And this might happen faster than people think, given where we're at, as in within years, perhaps within months or weeks or even days, but not within decades, given our unrivaled excesses juxtaposed against blue sky valuations in way too many bonds and stocks. Will history repeat? The message for those accounts with stocks purchased at elevated valuations that are still equity heavy in their exposure is this: keep your eyes on the junk bond market, for it will likely unravel prior to the US equity market once again. Reallocate towards safe cash, that is, from a US perspective, to T-bills, which have no duration risk, and to precious metals, which I continue to believe are vastly underpriced given the amount of money that's been printed, as well as our problems regarding insolvency, which will require even more money printing. Whichever shoe drops first, wait for bargains. That and easing up on overvalued assets remains the real message. The same holds true, obviously, for creditors / bondholders and real estate owners similarly exposed, that is, having purchased overvalued bonds and real estate. And speaking of shoes, perhaps Trump's mercurial trade antics, his frequent 180s or contradictions, and his endless claims inflation have so poisoned the negotiations well that the Chinese are ready to shut him down, as current headlines suggest. While this could just as easily be Chinese posturing to get more leverage in the next round of this ongoing insanity, it may also cause alpha male Trump to lose it. stock market be damned. Perhaps that's the shoe that drops first. Wilder and stranger things have been known to happen. Of course, that would bring the Fed fire truck and its big monetary hose to the rescue at the drop of a hat. Do recall, however, that it took massive liquidity injections in 2008 and 2009 to finally get the stock market, the US stock market, the global stock market, to stop plummeting. The US stock market fell by more than 50%, I think 52 or 53, into early 09. Here's hoping that you have found my thoughts worthy of consideration, especially as regards your investable asset allocation. This is Dan Kurz of DK Analytics, signing off on October 31st, one day after the Fed's decision to cut the Fed funds rate by another 25 basis points, after which accommodation will allegedly be put on hold. When have we heard this before? And how long did it last amid signs of mounting economic weakness or a Wall Street hissy fit? Collapsing stock market. But I thought we had the strongest economy ever, Mr. Trump, so this won't be necessary. Right, Mr. Powell? Good grief, what a silly world we live in, filled with even sillier sound bites. Where did all the adults go? Thanks for listening. Bye-bye.